Bugatti Supersport 300 Plus, listed as one of the fastest cars in 2023. Kind of like the and asset. High early cash value, 80 to 90% liquidity right away, optimally designed overfunded whole life insurance to optimize the best version of yourself. But what if you took that Bugatti and attached some NOS to it? What if I told you, just like adding NOS to the Bugatti, there's a way to add NOS to overfunded whole life insurance? Would you want to know how that works? I mean, we are talking about life insurance, so most would probably be like, no. But you are a special type of breed. A breed that man has not seen before. You enjoy listening and learning about life insurance. So let's have some fun and let's look at the Bugatti on NOS of whole life insurance. Just like the Bugatti on NOS, there are some drawbacks. Nothing in life is perfect except for Christ himself. So we are going to look at the pros and the cons of the strategy and everything you need to know about it. For starters, some of you are already very familiar with the strategy. And for others, this may be your first time. So the name of the strategy is called, the drum roll please, the front load strategy. Even if you are an agent and have been around for 30 plus years, I promise you will learn something new in this video. This has come from running thousands of illies, aka illustrations, with multiple companies to see what's possible. So let's go ahead and dive into the numbers. Here are the numbers for a $300,000 front load with $50,000 a year going into the contract therefore after. You'll see that the very first year, there's $282,000, which gives you a liquidity of 94%. And so when I talk about this being the Bugatti of whole life insurance, it's because you have so much liquidity up front. And when we look at the break-even point of the contract, the break-even point happens at year 4. Year 4 of the contract, you have $458,000. The other powerful point to point out is once I put $1 in after the first year, I get more than $1 back. So I put in $50,000 into the contract and my policy grows by $55,683, which is absolutely insane. And what you can see is after that, it continues to grow by more and more and more. So you put in 50, you get 58. You put in 50, you get 61. And so you can see how this contract gives you the ability to have so much liquidity and have the growth on your policy grow at an exponential rate at the very, very beginning of the policy. Just like a Bugatti, straight out the gate, boom, 0 to 100, super fast, let's go. In this specific front load design, this is a 30-70. So when I say 30-70, I mean 30% goes to the base, 70% goes to the PUA. We always say the base first, and that'll always stay consistent throughout this video. Now you may be asking, why not do a 1090? Why not do a 1585? In a lot of your videos, you say that the lower the base, the better the policy performs. That is true, but there is a caveat. The caveat is these insurance companies only allow so much base to PUA ratio when we're doing massive front loads. And every single company will have a different ratio on what they will allow. The other thing to consider is when we do massive front loads, the farther away this first year contribution is from this contribution, the higher the base has to be. And so you'll see that throughout this video, why we can't do a 1090 and why the bases keep getting higher, but you'll see that the policy still is not being affected from a cash value perspective. It still grows exponentially, is very, very profound in regards to how much liquidity you have up front. And what we're going to do is we're going to compare a 50-50, a 70-30 compared to a 1090, and what happens if you do a 1090 in regards to a contract with their front load policy. So let's go ahead and dive into the other examples. So this is a $300,000 first year front load. The next example is going to be a $500,000 front load with $50,000 therefore after. With these designs, we have kept the annual contribution after the front load consistent at $50,000 a year. What you'll see is there's $471,000 in the very first year, which gives us 94% liquidity as well. So it's a constant theme, 94% liquidity with a break-even point happening in year 4 again. And so we have 94% liquidity, breaks even year 4. This policy, once you put $50,000 in, you get $60,000 back, $50,000 in year 3, and we get $63,000 back. You can see the difference in regards to this contract to the other contract in regards to year 2 and how the policy grows. Year 2, in regards to the $300,000 front load, you can see that the policy grows by $55,000 in year 2. When we have a $500,000 front load, you can see that we're getting a $60,000 return back in our second year. This policy's base to PA ratio is a 50-50 design. So this is my point and reason where I'm sharing that just because this has a higher base, has a 20% higher base, it doesn't necessarily make it any worse than the other policy that has a 30% base. Why? Well, it shows I have 94% liquidity year one still. My policy still breaks even in year four, and I'm actually getting more cash value per dollar that I put in starting in year two. In this previous one, it goes up by 55, and this one, it goes by 60. And the only difference is the amount of money that I'm putting into the contract. And the other difference is actually the base, right? The base is a lot higher and the PUA is a lot lower. So again, as we have the common theme throughout this video, I do say that it's better off from a cash value perspective when we have a lower base than when we have a higher base from a cash value perspective. But that doesn't necessarily apply when we're looking at it from a dump in perspective. When we have a front load massively being injected into the policy, the rules slightly change a little bit. The next design we're going to look at is a $700,000 front load. So if we put in $700,000 into the contract, you'll see that we have a 94% liquidity with $659,000, and we have a break-even point happening at year four once again. Common theme: 94% liquidity, breaks even in year four. And this policy, you put in 50, and in year two, it grows by 64. And this policy is actually a 70-30. So 70% is going to the base, 30% is going to the PUA, but the policy is performing better on year two, 64,000 versus here, 60,000, which is a 50-50 base to PUA ratio with the $500,000 dump in. And then if we go to the 300,000 with a 30% base and a 70% PUA, you have only 55,000. The reason this is because compounding interest consists of three things. It consists of time, it consists of interest, and it consists of volume. And what we're doing is we're increasing the volume at a massive rate at the very beginning by injecting a ton of money. The more money you inject into the policy right off the bat, the stronger the policy is going to perform therefore after, even with the same amount of contribution going into the policy after that. Now, something that I want to point out is if we did do a apples to apples comparison, where we did do a base to PUA ratio of one being a 70-30, so 70% base, 30% PUA, with a 30% base to a 70% PUA, and the numbers were exactly the same. So essentially, if we took this contract here at the beginning, this one is a 30% base to 70% PUA. If I did change this to where is a 70% base to a 30% PUA, the lower base will outperform. So I want to be completely straight and frank with you, is that the lower the base does improve the policy if it's an apples to apples comparison. But we're not doing apples to apples comparisons when we're comparing this contract to this contract to this contract, because we're putting in more money into the contract. And if we try to do a contract design where we did 30% base, 70% PUA, the insurance companies would not allow that to happen. And the reason why is when you do something like that, this is a prime example. We're doing $1 million into the contract, and I tried to do a 70% base to 30% PUA. The insurance company said, nope, we're not able to do that based off of the limitations. If you do that, this policy will mech. So essentially, no matter what design I try to do with this contract, with so much money going into the policy, $1 million right off the bat, this policy will mech no matter what. It's essentially saying you're shoving in too much money, and this no longer looks like insurance. This now looks like an investment. Therefore, you're going to lose out on your tax advantages, and this policy is officially a mech. So again, to summarize, the higher the front load, the higher the base has to be for the insurance company's limitations. But if the contract's premium in the first year becomes too much based off of the annual contribution, therefore after, the policy will mech. But you can see how sexy this policy is when we look at it. You have $953,000 in the very first year, which is close to 95% liquidity, and the break-even point happens in year three. And all the other contracts, we had 94% liquidity, the break-even point happening in year four. But when we're shoving this much money right away in the policy mechs, we're getting 95% liquidity with the break-even point happening in year three. The other thing to consider is when we put in $50,000, we're getting $77,000 back in year two. That's absolutely insane. When you can put in 50 and get an extra $27,000 back in return on your cash value, that is an unbelievable return on our dollars. Now, at the beginning, we asked the question, well, why not just do a 1090? Well, the reason is because the policy like this will essentially mech. And so if we take a look at the design in the very first one of a $300,000 contribution in the first year with $50,000 therefore after, the only thing I did is change this design compared to this first one we looked at to the base to PUA ratio. So this base to PUA ratio is 30% base, 70% PUA. And then when we look at this design here, this is 10% base, 90% PUA. And the insurance company said, sorry, we can't do that. The base is too low, therefore the policy mechs, which is why I had to increase the base to 30% to allow the policy contract not to mech. And you can see that this policy is unreal when it mechs though, and it's a 1090. So when we're comparing a 1090 to a 3070, the 1090 is going to win and blow it out of the water. And here's why. When you look at the liquidity within the first year, you have almost 97% liquidity within the first year. And the break even point happens in year 2. You put in 350 and you have a total of 350,409. You don't get that anywhere in insurance. That's not possible to do that in insurance without meching the contract. But when we're able to mech the contract, do a massive front load, and inject money like that, you can see the profound effects that it has. But the downside is we lose out on our tax advantages, which essentially means that when you use the funds, you now have to pay ordinary income tax. And on top of that, if you're younger than 59 and a half, you have to pay a 10% penalty. And with the way that we use the contracts and the strategies that we use, we're able to use the cash value tax-free, and the death benefit does continue to get paid out tax-free as well. And so if you wanted to go back and compare this contract to the other contract, just we had an apples to apples comparison, the base to PUA ratio, you'll see again, it's 290 year one. And if we look at the 3070, there's 282 year one, right? So almost a $8,000 difference. And if we come back to this contract, we said already breaks even year 2. This contract over here breaks even in year 4. And again, you put in 50, you get 55 back in the first year. If you put in 50 on the mech policy, that's a 1090, you get 59,917 back in the first year. Again, I'm sticking to my guns. If the base is lower and the PUA is higher, the cash value will perform better. So if cash value is the goal and the sole focus and only the goal, when we're comparing apples to apples of contracts, and I mean same company, same design, same everything, the only difference that I'm changing is base to PUA ratio. The one with the lower base will perform better from a cash value perspective only, not looking at any other variables. And I say that from a perspective of there are other companies that can outperform another company if we're looking at just illustrations that have a higher base than another company that doesn't. And I will show you an example here next on what I mean by that. And real quick, what I want to share with you is that you can do a 1090 with this contract. You just can't do a front load. And you can see the effects on how that changes when you do that. So let's look at a 1090, which is a $50,000 contribution, but there's no longer a front load. And so what it does is it now brings the cash value to 44,962, which is about 89 and 90% liquidity within the first year, versus the front load when we were injecting it with an extra amount of cash, which is why I call a front load strategy the Bugatti of whole life, is because you're able to get 94% liquidity with that design versus this design, you're able to get 90% liquidity right away. And the break even point in this happens in year 5, where we put in 250 and you get 255 back. So again, this contract is still amazing. You have 90% liquidity and your policy breaks even in year 5. You really can't get that in many places. You really can't do that unless somebody specifically knows how to design these contracts to optimize for cash value. And so when we're looking at this design, I am not pushing you or discouraging you away from this. This is absolutely an amazing contract. But if you don't have a large lump sum of money to inject into a policy right away, this is your next best option, which I think is an amazing option. This is exactly how I started my first policy. But again, this is a 1090. The policy does not mech. We're able to move forth with that. And you can see when you put in 50 in the year 2, you get 48,925 back. So you actually don't get dollar for dollar back until year 3. You put in 50 and you get 51,270. So I just wanted to share that with you real quick, showing you that it is possible to essentially do a 1090 still without a policy meching. The policy just does mech when you put in a $300,000 front load right off the rift. Okay, so now what I'm going to do is I'm going to compare 2 separate companies with the same designs from the same contributions. It's going to be $150,000 in the very first year and $50,000 therefore after. And what we're going to do is we're going to compare company A to company B, and we're going to show that things are dependent and based off companies, and things aren't always as black and white as they seem. So when I said that, hey, if we can put in the same amount of money, 150 and $50,000, and we change the base to PUA ratio. So with this company, company A, if I did $150,000, $50,000 therefore after, and did a 1585 base, which is, this is what it is. This contract right here that we're looking at is a 1585 base. This contract that we are looking at here is 15 base, 85% PUA. And when we do that, you'll see that we have a cash value of 141,000, which gives us 94% liquidity. You can see a common theme. It's amazing that one of the contracts we looked at had a 70% base and a 30% PUA, and we had 94% liquidity. We changed it to a 15% base, 85% PUA, and we still have 94% liquidity. The break-even point is still happening at year 4. So you can see the common themes, regardless of the base to PUA ratio, are happening within the contract. Now, again, I want to reiterate, if I did change this contract specifically from a 1585 to a 70/30, now I changed the base to a 70 and the PUA is a 30, I will have more cash value in this contract than I would in regards to increasing the base to a 70/30. And that's because the influx and inflow of cash is identical. So if the cash is identical, then you can then start looking at the base to PUA ratios. But if we're injecting more cash into a contract, sometimes you got to throw that out the window in regards to looking at base to PUA ratios. And here's kind of something to consider as well. When we're looking at a separate company, here's another company that is company B that's doing the same exact design, $150,000 in the first year with $50,000 therefore after. And if we compare, you have $119,000 going into the first year of cash value available. And you would ask yourself, well, that one has 119 and this one has 141. Why in the world would I ever go with company B versus this one with company A? Well, if you start looking at everything, you now have to ask yourself, what do you value and what's important to you? Because if you look at this contract, you have $2,435,000 of death benefit. When you look at company B, you have $4,023,000 of death benefit here. So you have almost a $1.6 million of protection to your family and to pass down from a legacy perspective right off the bat. Now, when we look at the break-even point on this contract, that happens in year 7. You put in 450 and you have 455. So again, you're asking the question, why in the world would anybody go with company B if we're looking at it from a cash value perspective? If my policy breaks even year 7 versus this policy here, my policy breaks even year 4, like all of the other contracts we looked at, and this policy breaks year 7, that's a 3-year difference in regards to the break-even point. Well, it doesn't always tell the full story. When we start to look at the contract from a longer period of perspective, if we look at year 20, okay, so 55, the contract premium we've put in is 1.1 million. When we look at it from a longer perspective, from a contract of year 20, age 55, the total cash value we have is 1.7, okay, 1.78. When we look at this contract here, and we're looking at it from the same time perspective, age 55, year 20, the total cash value is 1.6. So you can see that's $100,000 difference in regards to contract A versus contract B, 1.7, with a death benefit of 5.8 versus a death benefit of 2.9. So again, I want to reiterate, this contract versus this contract is not better than the other. They're just different. This contract here is actually a 50-50 base to PUA ratio and doesn't have as much cash value early on, but it has way more later on, and it has a higher death benefit at the beginning. This contract here is a 1585. It has more cash value early on with a smaller death benefit, but has less cash value later on with a smaller death benefit still. So what do you value? And that's why it's important that you work with somebody that's going to ask you the questions on what's important to you, what do you value to your family economy, and then allow you to choose and make decisions based off of what you've shared with the person. And I truly believe that if someone can ask you great questions, you understand the product, you are educated, you're going to get exactly what it is that you want and understand how the tool works to go make yourself a better individual, to go make a stronger impact in the world, to have an and asset, to be able to do this and other things in your life, to show up powerfully for the people around you. And I truly believe that if you would like help with that, we are the best company to be able to do that and provide that. If you feel like you are fully educated and ready to talk to somebody about your specific scenario and your specific numbers, we would love to be that person to help you. Click the link below in the description. This is the and asset clarity call. We would love to be able to talk with you, ask you great questions, see where you're at, show you the numbers. And if it makes sense, we can then move forward with the next steps and talk about what it would look like for you to get started with an and asset.